There's a new way to stay connected and know what's happening with Market to Market when you subscribe to Market Insider. One email and a lot of information awaits you. Go to markettomarket.org and subscribe to Market Insider. A lot can happen in 6 months, especially when you have a presidential transition, old ways, new ways, and also some of the old consistent things that happen each and every year with supply and demand when it comes to grains. It's time for a little market analysis on the MTOM podcast. Josh Hayes joins us again from Hedge Plus, based in Wisconsin. We polled him back in December to see what he thought about things: corn, wheat, beans, soybeans, livestock, and hogs. We're going to do it again. We're going to see how those predictions held up. I'll give you a little hint. We're going to talk a lot about tariffs and deals and what that means for agriculture in the months ahead. Does it have to be ink? Do you have to see the work? Does it have to be significant? We'll cover it all with Josh in this installment of the MTOM podcast. I'm Paul Yeager, your host. New episodes come out each and every Tuesday. Let's get to our discussion. Almost 6 months to the day, Josh, we last talked. So I am going to hold you to every letter of what you predicted 6 months ago. You okay with that?
Absolutely. I feel pretty good about what we said. Now I'm gladly admit the things we were wrong about too. Which wasn't much.
What did we know? I mean, we knew when we last talked at the end of December, we were approaching lots of things. And we knew Trump had been elected. We knew that was going to happen and what that would mean. Let's start politically first. Did everything you thought that was going to come true has come true?
Yeah, I'd say so. We knew the reason behind the tariffs. We knew that countries couldn't withstand them very long. We knew a lot of it was more about exercising our leverage. And we definitely didn't think China would hold out too long either. The one thing I would say I was wrong about, and I don't even know if I said that on your program, but I said it in a lot of places, was I didn't think the tariffs would even have to go into effect, because a lot of these countries were staring at almost instant recession and major impacts right away. And just the thought or the threat of the tariffs, we thought, would lead to countries coming and making deals before they even took an effect. Well, in reality, these countries played a little bit of hardball, tried to hold their leverage as long as they could until the last minute, but very quickly, came and, deals are going to start rolling out pretty rapidly, we think, here soon. But the other aspect of it with China, with talking about their economy couldn't withstand it, nothing like the position they were in 2018. Not only did they come to the table pretty quickly, but word's starting to come out, and this is sourced on Reuters, Wall Street Journal, Zero Hedge. They're all indicating that, China reached out about a month ago, which is pretty soon after the tariffs took effect. And one of the stipulations they placed was that those talks that they had a month ago remained secret. They didn't want it to look as though they were caving to Trump. And so China actually came forward pretty quickly. The impact was definitely felt much greater by China right away than it was in the United States. Some factories started to shut down, ships turned around. Some companies in China were already facing bankruptcy, so they did need to get something relief from these tariffs pretty quickly. And then there's the aspect I'm a little disappointed. I think it's going to take longer than I would have thought to get the deals actually done. And I think the market is also going to have to wait to see more. Not just the faith that the deals are going to get done, that the deals are actually signed and done before we start to see an impact in prices.
They want to see ink on the paper. Yeah.
It was good though.
Okay.
That the UK deal that real quick, that the UK had such an emphasis. That deal had such an emphasis on farmers. I mean, that was the first thing Trump mentioned. Ag Secretary Rallies was very vocal on media, social media, about how these deals were going to help farmers. And it definitely indicates that that's going to be a big priority in all these deals, which is something we were glad to see and something we expected as well.
One of the things we'd heard inside China was that they are, as a people, were being postured to that America was the bully and they're going to stand up. But the United States also, there's people in this country who say America is the bully or China is the bully. I mean, there's both sides being talked about as who's really bluster and who's for real. What does that do to people that you talk to on a regular basis on the phone who are like, Josh, I'm kind of nervous about what's going on? How do you play the role of therapist knowing that there's all of this posturing going on?
Yeah, exactly. It's not only our clients, but it's just what's out there in the media, and it impacts traders too. You pretty much have to assure them that it's for the right reason, which I truly believe. I don't know if we talked too much about this back in December, but we did talk about leverage, and it was disappearing leverage for the United States. If we didn't do this now, trying and balance this trade, there'd come a time where these countries, which were actively trying to find ways to replace having to buy from us, that they would successfully be able to do so. China was already on that path with what they're trying to do to develop South America so they can get more of their egg from South America. There's countries trying to develop farmland in Africa. And, just outside of agriculture, these countries are trying to, get factories built and build up consumer bases in all these other parts of the world so that one day they could have, completely ignored these threats. It wouldn't have harmed them. But it did have great impact on these countries, and they did have to come to the table quickly. Ultimately, that's the justification I try to give people. We're not trying to do anything that's unfair. We're trying to bring some jobs back to the United States. We're trying to expand our markets, countries that there's really no need for them to avoid buying some of our agriculture. I don't see anything that's being done with Canada yet about the fact that they don't buy our dairy products because of the tariff they have on our dairy, which is exorbitant, and it's been there for decades. But, there's no reason why the UK shouldn't be buying more of the agriculture from us. And we still produce the highest quality agriculture. And that was actually one of the things that popped up in the past month as China tried to shift their buying from South America, step up their buying. They ran into a lot of logistical issues and the quality issues. So we had to do this now while we still can, because the leverage would have disappeared eventually.
Was there one commodity in particular that you think was caught up in this trade back and forth?
It definitely appears to be the soybeans from the bounce we've gotten since, I guess, the initial step that was taken this week with the tariffs being lowered, the rates being lowered. But we've had corn and wheat drift down, but I don't really think that has much to do with the tariff standoff. That's definitely weather. But yeah, soybeans, it's odd. I saw the same headline early in the year that just popped up back today about this. If China doesn't make a deal with the United States, the U.S. is going to lose 20% of its soybean sales. It's almost as if it's another push to scare people or put people in doubt that it's actually going to happen. I don't even worry about it happening. One, I'm very confident it's going to happen. I think these deals are absolutely necessary for everybody, United States and the other countries on the other side. But it's not that simple. If China were to just, blow off the United States, ignore the tariffs, and say we don't need to trade with you, if they were to shift those purchases to South America, the prices are only going to go up in South America. South America can't meet all of China and all of the world's demand. It would have just shifted demand to the United States. Countries that maybe typically didn't buy from us, as soon as they saw a cheaper price in the United States, they would have come to us. So it's a headline that just keeps going out, getting circulated and regurgitated, and that's unfortunately has held back trade. And I think I've expressed it this week, and I've seen other people start to say it as well, that it seems as though the trade is not buying into fully what the USDA is projecting for demand. And I guess once they finally do buy into that, then maybe we'll see prices start to rise.
Oh, that's not the first time that USDA maybe has lagged behind what maybe is reality. It's that one is just it's more of a cautious number, do you think, than it is an aggressive number when it comes to what we think for exports or what we think through demand, what we think we're going to use? Is
Well,
that
I
fair?
wouldn't even say cautious. We're actually thrilled with what the USDA put out on Monday. It seems as though the industry is skeptical that we're going to continue having demand climb each year. I mean, they're even showing, if there's one number I'm skeptical of, they're showing that we're going to still have increased demand for wheat. I just, that I'm starting to just not feel too strong about that. I think the world is moving away from wheat. Wheat doesn't have the added uses, like we have with biofuel and ethanol. That just doesn't quite exist with wheat. And I think, so I'm a little skeptical about that. But as far as demand for corn and beans that the USDA projects, putting us at, pretty considerably tight stocks given record production for corn and ending stocks below 300 million bushels for soybeans, even though they're projecting trendline record yield. So that's optimistic. It actually says that if we have any issue whatsoever, we could get tight real fast. And that's why we think, we never root for a drought. We certainly never count on a drought, but we do know there's always going to be weather scares. And when we get those weather scares this year, even if it's brief, prices will probably go higher because really none of this is getting priced in right now. So, and if that's because people are still skeptical that we'll get these deals, then so be it.
And even if the United States isn't the biggest dog at the dish, it's still there and it still matters, is what you're
Right.
saying.
Right. It's a finite supply.
Okay.
What we produce goes into the pool, and it's what the world's using every year. You can't just stop buying from the United States. Then the prices everywhere else would skyrocket. Eventually, countries are going to come back to the U.S. So even if China were to avoid buying from us, someone else will.
Well, let's go back to wheat then, Josh, for a moment. You talk about, I think 6 months ago, we were looking at Russia, Ukraine. We're still looking at that. Now it's a little more of a weather issue. If there is peace there, which of those factors and a huge supply is the biggest for wheat moving forward?
Yeah, I think weather is pretty much off the table. I mean, I go back and forth reading about weather with Russia and Ukraine every day. One day it's too wet, next day it's too cold, next day it's perfect, right? So, and next day it's been too dry. So, the reality is the supply is there, the projected ending stocks are there. We're not going through supply fast enough. We talked about a range on wheat for this year of 550 to 650. Well, it looks like we might have nailed the top there with that one. Probably didn't, definitely came earlier than we expected. And we were happy to have made sales then. But I think I overestimated on the bottom. Obviously, we went below 550. We got near $5 this week. And I think hopefully we've landed there and we've put in a floor, but not real optimistic there. The USDA, I think, has us at what was it? Was it nine projected 9-year high for ending stocks for wheat at the end of this year? And that's not a very favorable picture for wheat. So unfortunately, it looks like the high might have already taken place this year. Unless, of course, we
for the next 6 months.
We say that with always saying can't predict a black swan. So, but we do. One of the things I emphasized when we met back in December was that we felt like we're coming back into those normal ranges: a $1 range with corn and wheat, and a $2 range with $2 range with soybeans. And it looks like that's where we're going to be unless we have some kind of major scare. So if there's no war, I think they're going to have a peace deal soon. And if there's not some major weather issue, it's going to be just your trickling, your small moves up and down. But again, like I said, then that's still a dollar. So you want to make sure that you're making your sales and you're advising and giving out those recommendations at the top of that $1 range for corn and wheat, and at the top of that $2 range for soybeans. We haven't made a recommendation yet for new crop soybeans. We think it's best days are ahead. But we made a big recommendation in February on wheat at that high, and we made a recommendation on corn at that time as well. So
we'll get back to your recommendations in a minute. I want to go back to something you just said, which is also tied to our earlier discussion about these deals. You mentioned we need to see ink. Just because it is said there's a deal, and I asked this to another couple of analysts, is it a good deal? A deal is not, what if it is the same and there's very minimal change? Is that enough to move the market or enough to appease people saying, see, we got change?
yeah, it's definitely going to vary. And yeah, the key will be in the details. So far we only have the UK, and I think it was significant what was in the deal, which is why I'm optimistic that farmers are going to be a priority in these deals. But the reason that one didn't move the markets because it's just the UK. It's not a huge deal, so the market's definitely waiting to see deals with Japan, China, obviously. Even Mexico, Mexico, it's just funny that two of the ones we're banking on the most, China and Mexico, they're having some real weather issues. And, China's having some major problems with wheat. They just made a purchase a couple weeks ago, round of purchases with Australia and Canada. I have no doubt in my mind those deals could have been made with us if what's taken place since the lowering of the tariffs. So yeah, we definitely need to see, that they can't just be small deals. I know one of Trump's objectives is to leave behind a 10% tariff in place on everyone to generate revenue to offset some of the federal income from income tax. And that'll be something will have to be overcome because even at 10%, that's a price put on top of our goods that, we run in tight margins trying to compete with South America. So these deals are going to have to include commitments to buy our grain. And that's what the 2018 deals did. And that's what China has already, I believe, even on their own volition, indicated that they're going to get back to honoring those commitments. So that's a good start. And then, yeah, I mean, heck, to have UK have a 19% tariff on our ethanol meant they weren't going to be buying any. Well, that's gone. It got dropped down to zero. So, okay, that's what Trump said leading up to these tariffs is about opening up new markets. And yeah, if we weren't selling any ethanol to UK and now we can, that's definitely helpful. And we hope to see that obviously amplified with bigger deals with countries that buy more and, have that accentuated.
Is a move to year-round E15 enough to help corn? I mean, it's not. We're looking E10 to E15. That's 5 percentage points. That is, some bushels. But is it enough to influence the market higher and chew into a pile?
Yeah, it definitely hasn't so far. And as a matter of fact, ethanol report just came out that I think we're at like a 53-week low on production. Remember, some of that is because this is seasonally the lowest time of year. So, in one sentence, you say it's the 53-week low for production. And next sentence, you realize that for this week in the year, it's something like the second or third highest. So production's down right now because this is when it typically is. They should be ramping up soon. Now, if they don't ramp up production into the summer driving season, then yeah, that's something to be concerned about. But I think the more that has to do with the low price of oil, which if you let me segue to that, I think oil was a big part of this strategy. Trump knew that one of the criticisms of putting on these tariffs was going to be inflation, and that was going to be used against them. So he didn't do this on day one. He did a lot of things on day one, but he didn't implement these tariffs until April because what he did first was make sure that oil production was ramped up, oil prices came down as an offset for tariffs. He doesn't want it to be there forever. He wanted inflation to come down to prompt the Fed to lower rates. He definitely wants that to happen to really jumpstart our economy. At some point, he's either going to get his way or he's going to have to abandon it. He's not going to want to keep oil prices down like this forever. When oil prices start to come back up, that's going to obviously help grain commodities, corn and soybeans especially. And your clue on that, I'm going to tell you right now, when Trump makes a move to refill the strategic oil reserve, it's because he's confident the low is in. I firmly believe that. So when we see that, I think we're gonna that'll be right before the the production levels on oil get turned down. He's in the Middle East right now, no doubt making deals on that, no doubt coming up with a plan, and that's going to be our tell is when he starts to refill the strategic reserve, then I think you'll see that that's probably the bottom for oil.
What else in corn here in 6 months that you see that you think holds? It can't all be ethanol. It has to be use. Corn has been, in the last 6 months since we've talked, has been the strongest of them. Can it continue to be the strong?
I think the potential is actually highest for soybeans, but corn is probably going to be the steadiest and safest. And I think we'll see corn included in some of these deals. I think one of the things that's really talked about isn't just about getting countries that buy these things from us already to commit to buying more, or, instead of shopping around and price shopping, get it, inked in stone as far as purchases. I think it's going to be countries that don't typically buy from us also starting to buy from us. And that I think is definitely going to be with corn, and not just through ethanol either. And right now it's, you do have one factor holding corn back a little bit is one change the USDA did make this week with South America production is they did raise the production for Brazil's corn crop, and that's from the safrinha crop being in really great shape. That safrinha crop season's going well, and that was the first time they've made an adjustment to anything in South America, and they raised that up. So there's going to be that to compete against, and at these projected ending stocks, I mean, we're tighter projected ending stocks than we were at this time a year ago, and prices were $1 higher. So right now, I truly believe the biggest thing holding the markets back is, it takes, got 3 months of everybody saying doom and gloom, and this is a terrible idea, and we shouldn't be doing these tariffs, and these countries don't need us. And it takes a while to let that go and to accept that, no, these deals are going to happen and the demand's going to be there. And if it is, just like the USDA is projecting, we are the smallest weather risks away from bounces, but they'll come back down. Unless we have some major weather issue, the crop's going to be there. It's going to be a big crop, big corn crop. And, so that's why any kind of bounces, you're probably going to have to capitalize pretty quickly. As soon as the weather scare goes away, which we always want it to, we don't want actually to have a full on drought or anything like that. Take advantage in those quick jumps, and then be patient again and wait till the next one.
Is that window only open through pollination in mid-July when that's complete?
Yeah, we had a year. It was 2012. Unfortunately, that was more drought driven. That the best sales, year saving sales for farmers were made in late July. But we want to have we have basically one more sale to make on corn and beans on old crop, and we're looking at that coming in the next 2 months. It's always a gamble. It's a gamble to be sold out right now, to be honest with you. If you sold out last week at 450 and 1050, it's a gamble that you're going to miss out on much higher prices, because we're on a razor's edge of anything that could drive prices higher. But it's still a gamble, because what if we don't? What if the weather stays great, right?
Are you selling out on old crop there or new crop?
This would be for old crop. We're looking to make one more sale. Yeah, by certainly before harvest. But we've held off on making that last sale. We have, like I said, we've made a couple of initial sales with corn dating back all the way for a new crop, dating all the way back to last May when we sold 10% on this year's new crop that far in advance. Then in February, we made another 15% to bring us to 25% sold on new crop corn, but no sales yet on soybeans. Price just hasn't been there. And, we think it's got a lot of room to go higher. When I met with you back in December, I talked about 950 to 1150. Definitely 1150 is definitely still possible. The only thing is we could blow past that. We could easily blow past that with these projected ending stocks. And, expecting record yield, I'll give you a great example. If we have soybean yield, just the average of the last 3 years, and we don't set a new record, we don't continue to go higher, just the last 3-year average would put us at pretty much pipeline levels at these acres. So soybeans actually have potential to go blow past 1150. It hasn't happened yet, but I would actually start to safely say we wouldn't put 950 as a realistic option anymore. I don't think we'll get anywhere close to 950.
Is that with or without trade deals?
I'd say it's with trade deals because I'm very certain that these trade deals are going to happen. It's in everybody's interest to make them happen. And like I said, the biggest fallback is let's say China and the U.S. their negotiations drag all the way out to the end of the year, and we've already got the new crop coming to market. It still doesn't matter if they're not buying it from us. Somebody else will. It's just the reality. The South America is not in a position to supply the whole world, including China, with all their soybeans and corn right now. So I'm fully confident the deals are coming and they're going to include these grains, but it's just, it's a finite supply. So anything that any additional sales that take place there, it's going to mean some countries that normally would have bought from Brazil or Argentina they're not going to be able to fill all those orders if they fill everything for China. So those countries will come to us. And I think that's going to happen regardless of whether it's forced to because China's taken all their beans or via trade deals. And I think we're going to see, what did we just have? We had Pakistan buying from us for the first time in 3 years. And I think some of those sales are preemptive, get on good terms with the Trump administration as you're trying to negotiate these deals. And I think that's the kind of thing. The easiest thing, Patrick says this all the time, the easiest thing for these countries to agree to buy from us that doesn't hurt their own production. These countries produce electronics and, clothing and cars and all those things. The easiest thing to agree to buy from us to make us happy to get these tariffs lifted is to buy food. And who's going to argue against you buying food for your people? And then on top of that, they talk about China putting out the warning, don't start, buying from the U.S. anything you typically buy from the U.S. Well, food. You're not going to anger China by agreeing to a deal to buy food from the U.S. You're not in competition against any of China's exports. So that makes sense. It's logical. And it's just a world supply situation overall anyway.
It's kind of hard to buy, though, a lot of beef right now. I mean, it's expensive.
Yeah. I'm going to go on a limb here and say that something I've been starting to throw out there I think the cattle market's starting to, in a lot of ways, mirror the oil market. You've got, the packing industry is so consolidated. Margins are so narrow, it's leading to consolidation with ranchers. And when you get that way, you can kind of start to control prices and you can try to make sure they're in a range that's the most profitable. And right now, with feeders over $300, you kind of need live cattle to be at least $215 to have a chance at making money. And, with competition out the window, they can kind of pretty much drive things the way they want. And they've driven it so tight supply that any disruption it's just amplified. So screwworm hits, and the issue we had with Mexico last month, and any kind of issue is gonna send the market soaring. And on the other aspect, I I saw your was it Mark Stone from the studio show, and he was talking about what price does consumer demand start to fall, and that's definitely what's going to eventually stop this, right? Though I totally agree with them, and the only thing I'd add is that it kind of seems like people are willing to pay whatever it takes right now. Well, obviously, that's got a breaking point, but I think there's a true dietary shift. I think there's a lot of people eating more beef, even if it costs more. And it's a dietary reason. There's a big push right now for there's a lot of diets centered around eating meat and getting away from processed grains and processed foods and sugars, and so I think that's part of it too. Is if people aren't gonna stop buying as these prices rise, the consolidation of the cattle market is just going to drive it as high as they can go until it finally meets some resistance. And I don't think that's happening yet.
So in your eyes, this is more of a consolidation issue than it is a low number of supply and just low number of cattle in the United States that's driving this higher?
Right. It's definitely low supply, but I think that's part of it. The consolidation is it's control of supply, really. And it leaves the market very vulnerable to, like I said, just about anything. And, when you can, it's the same way OPEC controls the oil supply, and to try OPEC and the oil, all the oil producers, they like to have oil between $65 and $85. And they can't always make sure that happens, but they definitely have an oversized role in that, in how that shakes out. And I think that's what we're seeing in the cow market, an oversized influence. It's certainly not, there's no OPEC organization, but four big packers and the way they control that side of the market leads to, unfortunately, a lot of the smaller ranchers getting out of the business, and only the large survive, and then that leads to even more consolidation. So, yeah.
Maybe we'll have to come up with our own 4 letters to describe the
Right.
packers on another thing.
Maybe the first letter,
and then we can trademark it.
Big 4, yeah.
There you go.
Yeah.
We'll come up with something. Quickly, as we finish with hogs, this is a market that has had a couple of dips up. Is it an alternative to beef? Is it an alternative price-wise?
Yeah, I think it's a little bit of an alternative. I don't think maybe that's where we'll see the next drive higher with hogs, is when people finally relent to high prices of beef, but they still want to, eat more meats, right? And then maybe they'll shift to hogs. But hogs have been more susceptible to the trade deals, and needing China's demand. So that kind of bounces back and forth, kind of the same way soybeans do. And when things are looking good with China, hogs take off a little bit, and as soon as the scare comes again, the market dips, and that's kind of where we're at right now. We were sitting around $100 for quite a while there, dipped back below. Haven't looked today, but I'd be surprised if we're back up to 100 just yet. So that's that market, I guess, isn't quite as susceptible to disruption, because there have been some disruptions in the hog market aside from just trade deals and whether or not a deal would get made. But yeah, I think you might have nailed it, that we'll eventually see the hog market pick up when people start shifting to a cheaper alternative to beef.
All right, lastly here, we know that trade deals take months, sometimes years. Can the market sustain the headlines back and forth? Yes, a deal, no, a deal, not the deal, not a good deal, bad deal, really good deal. Can we withstand that for 6 months, and will the market have patience?
Yeah, I think I think we're in a good spot, actually, because I think the markets are ignoring. I think any deal that gets signed is only going to be a positive, but unfortunately not a big positive. We saw that with the UK deal. It didn't even shoot the market up in the initial minutes after that deal came out. But course, bigger deals could have a bigger impact. But what I think is going to happen is who's going to take the chance? People may not be betting on these deals coming, but who's going to bet against them? So how much lower can we go on the doubt? I think the doubt that the demand the USDA is projecting is going to be there. I think that doubt is gone, and I think that's priced out. So I don't think we're going to have huge leaps from any deals that get announced. I think that's still going to be weather. But between weather and the deals that come and having the numbers show up, the more that demand gets cemented as reality, it has no choice but to pull the markets up just on the pure fundamentals of it. So, yeah. We're
Anything else written on the piece of paper there to your side that we didn't cover?
Oh, man, so much. But no, I think we pretty much covered it. Yeah, I'm glad I got to mention that about that little prediction about the oil market. When Trump makes that move
it
on
works
the
out
strategic
sometimes.
reserve, you can pretty much bank that he feels the low is in and that the oil prices are going to start coming back up. But right now, like I said, he's holding out for the Fed to reduce rates. So you might have to abandon that. They seem pretty stubborn.
All right, very good. Josh Hayes, good to see you again. Thank you so much for the time.
Thanks, Paul.
If you have feedback for me, send me an email at markettomarket@iowapbs.org. Like, subscribe, tell a friend about this podcast. We'd really love even some reviews, if you don't mind. Maybe we'll even read them here at the end of the next podcast. We'll talk to you next time. Bye-bye.